Hello friends, today we are going to discuss about depreciation and some portion of Ind AS 16 which talks about depreciation. So in this particular session what we are going to learn is understanding depreciation. We'll understand what is the meaning of depreciation, depreciation methods, what are the methods allowed and practiced by the corporates, depreciation calculation under different methods. So under different methods we need to see that how the depreciation is calculated, how it differ from each other. And the last is requirement under Ind AS 16. So we'll see any particular law or specific activity which has been defined by Ind AS 16 in relation to depreciation. So let's understand what is the definition of depreciation. So depreciation is a measure of wearing out, consumption, or other loss of value of depreciable asset arising from use, inflation of time, or obsolescence through technology and a market change. So it is very clear in the definition that depreciation is a measure way to quantify, okay, the wearing out, okay, consumption and other loss of value. So whatever loss of value in a particular asset, that has to be quantified, okay, and that has to be charged to your profit and loss account, correct? So in this case we need to identify which are our depreciable asset. Not all assets are depreciable. Like for example, land will not depreciate. It will be the reverse case where the value of land will grow in future, but depreciable asset like plant and machinery, building, those cases the asset value will reduce day by day. Okay, so we have to quantify and charge that portion to the profit and loss account. Okay, now let's take quickly one example that you have a car. Okay, the price is 10 lakh rupees and you buy this car on 1st April 2020. Okay, now after 1 year, on 30th June 2021, okay, Mr. Henry shows interest to buy your car. Okay, and you are also ready to sell it because you want to buy a new car. You want to sell this car. So Mr. Henry is ready to buy. Now question arises whether Henry will buy it for rupees 10 lakhs. So you purchase from the dealer is 10 lakh rupees, and after 1 year, 3 months, you are going to sell to Mr. Henry. Whether Henry will be ready to pay you 10 lakhs. Okay, the answer is no. Correct. Car is a depreciable asset and the value will depreciate once the price will be below rupees 10 lakhs. Okay, that means at any cost, Henry is not going to pay you 10 lakhs. He'll try to depreciate the value of the car and will quote a lower price, which will be lesser than the purchase cost, that is 10 lakhs. Now let's try to understand why depreciation is required. What is the need of depreciation? The purchase of a fixed asset occurs in 1 year. That means today, if you have decided to buy a computer, you pay the full amount to the vendor and you get the computer, correct? But revenue generates from it over a number of years. That means you are going to use this laptop for 3 years, 5 years, or maybe 6 years, which is referred to as an useful economic life. So every asset comes with a economic life. That means a asset can be used for 10 years, a asset can be used for 3 years. So depends on the quality of the asset, the purpose of use of the asset, the life is defined, correct? The cost of a fixed asset is not treated as expense in the year of purchase. So today, if the company buys a laptop, it is not going to charge off the complete cost of the laptop in the same year, okay? But rather carry forward and write off to the profit and loss account over the useful economy life. So for example, if today I have bought a laptop for 1 lakh rupees and the useful life is 5 years, then each year I will be charging depreciation of 20,000 rupees, correct? Because the life of the asset is 5 years. The part of cost of fixed asset which is used or consumed during an accounting period is known as depreciation. Okay. So depreciation may be defined as the allocation of cost of a fixed asset over the accounting periods that comprise of useful economic life to the business. So it is very clear. We have to determine the useful life of the asset, and based on that, the cost of the fixed asset has to be apportioned and it has to be charged out to P&L account every year. Now let's take an example here. Suppose you have a car, the purchase cost is 10 lakh rupees and the economic life is 5 years. Okay, after 5 years you see that this car is not of any use. Okay, but this car, instead of you using for your purpose, you have put in a business, rental business, and the car will earn a rental income of 3 lakh per year. Okay, so 5 year, 3 lakh into 5, 15 lakhs it is going to earn for you. Okay, now question arises, how do I charge the car purchase cost to my profitability? Okay, so let's take two method to examine how the depreciation should be charged. So first method, full cost in 1 year. That means whatever purchase price I paid for the car, the same amount I adjust with the revenue I earn in the first year. Okay. So if you see here, year one, 3 lakh minus 10 lakhs. Okay. So you have a loss of 7 lakhs here because the 3 lakh is only the revenue and the cost of purchase of the car is 10 lakhs. So you have a negative profit, or you can say there is a loss. Correct. In second year, the total revenue what you earn is the profit because you don't have any cost from of car which you need to adjust here. Similarly, from second year to 5 year, every year you have a profit of 3 lakh. Correct. However, in the first year you have a negative of 7 lakh because the car cost is completely adjusted with the first year revenue. Now coming to the second method, what we have done here, the economic life is 5 years. Okay. The cost of the car is 10 lakhs. So we divided 10 lakhs by 5 years and we have calculated the proportion of the cost which need to be absorbed every year, and that comes to 2 lakh. Correct. So here if you see, there is a uniform way of calculating the profit and loss. The revenue is 3 lakh, 2 lakh is the cost, and 1 lakh is the profit. So if you see here, we have uniform profit in the second method. Okay. Now question arises, which is allowed as per the accounting standard? So first method is not allowed. That means because car is a capital expenditure, you can't adjust with the revenue directly in the first year. Second method is allowed because the proportionate of the cost has to be adjusted with the revenue and should be derived for profit purpose. So let's see what are the different methods for providing depreciation. Okay, so the following are the methods for providing depreciation which are used according to the nature of asset and the business. So if you see, there are a few methods we have here. One is fixed installment method, diminishing balance method, annuity method, insurance policy method, revaluation method, machine hour method, mileage method, depletion method. So based on the nature of the business or based on the nature of the asset, the depreciation method can change. However, in our particular case, we are going to discuss only for two type of methods. One is fixed installment method and second is diminishing balance method. So first we will discuss on fixed installment method. This method is also known as straight line method. So in this method, the amount of depreciation to be written off every year is uniform, okay, throughout the effective life of asset. The annual charge for depreciation is calculated by applying the formula given below. What is the formula here? So original cost of asset minus scrap value, okay, divided by life of asset. Okay. So in the previous slides, we talked about that depreciation we have to equally distribute every year. Okay. So when it is equally distributed every year, which is uniform in nature, that means every year the same amount is depreciated from the asset value, that is called a straight line method. Okay. So here if you see, there is a point we talk about scrap value. That means generally we have to estimate that if this particular asset I'm going to use for 5 years, at end of the 5 years, am I going to sell this asset on a scrap value or second sale? What is the estimated amount we will be getting at the end of the life of the asset? If we are getting some amount, then that has to be reduced from the original cost, and then we have to divide with the economic life of the asset. So let's take an example here. If an asset has been purchased for rupees 10,000, it will have a scrap value of rupees 1,000 at the end of its useful life of 10 years. That means 10 years is the economic life. Okay, the asset I'm going to use is for 10 years. The purchase cost is 10,000 rupees. That is what you pay to the vendor for acquiring the asset. And this asset after 10 years, when you sell in the market, okay, it will generate a scrap value of 1,000 rupees. Okay. The amount of depreciation will be calculated as follows. So taking the above formula, whatever we explained here, now we'll derive the depreciation per year. So depreciation, if you see here, 10,000 rupees is the acquisition cost. 1,000 is the scrap value because that is what we are going to generate. So the net cash flow or the net cost of the asset, if you see here, it is 9,000 rupees because 1,000 you are going to get at the end of 10 years. Divided by 10 years because this is the economic life. Hence rupees 900 each year will be the depreciation for you. Okay. And if you calculate on the percentage wise, then it will be 9%. Correct. 9% per year. So let's now understand what are the merits of this particular method, and then we'll understand what are the demerits of this method. Okay. So merit, if you see here, In this method, the assets are shown at their true value in the balance sheet because amount of depreciation is generally deducted from asset. Correct. This method is more suitable for those assets which have a fixed life, like furniture, leases, or you can say computers. They have a fixed life. So every year you transfer equal amount to the profit and loss account. Third, suitable for all type of business, whether small or big. This can be applied everywhere, and many corporates in India also they follow straight line method. Coming to the demerit part, the charge for depreciation remain constant year after year. Okay, the expense of repair and maintenance are increasing as the asset grows older. The profit and loss account thus in later years bears more than its share of valuation. So what it trying to give a point here is that when the asset becomes older, you require more maintenance cost. Hence, your depreciation is uniform every year. So the last years you will have a huge depreciation plus a repair cost. In the initial year, the depreciation will be higher, but the repair cost will be lower. So the cost on the asset will go up when the asset will become more older. Second point, this method does not take into account the effective utilization of the asset. The same amount of depreciation is charged irrespective of the use of the asset. So it doesn't take the usage of the asset. For example, if the asset is idle for 2 months, the production site is closed, still there will be depreciation for these 2 months, irrespective whether it is used or not used. Now let's try to understand straight line method by taking one illustration. Okay, we'll check how the calculation on depreciation is made. XYZ Limited purchased machinery for rupees 20 lakhs on 1st January 2018. The machinery is depreciated at the rate of 10% per annum on the original cost. So if you see the first line, it is very clear. The acquisition cost is 20 lakhs. Okay, the company is paying 20 lakh rupees to buy the asset. The depreciation rate is 10% and on the original cost. When it is on the original cost means it is a straight line method. Correct. On 1st July 2020, the machinery is disposed of for rupees 10,50,000 rupees. That means on 1st July 2020, the machinery is disposed of for 10,50,000 rupees. Prepare machinery account along with depreciation for 3 years. So we need to calculate the depreciation for 3 years, as well as we have to see that when you dispose of this asset, whether you earned any profit or you had a loss. Correct. So for this, we have to open the ledger account for machinery account. Okay, and then we need to see that how the calculation will impact the profit and loss on sale of the asset. So here if you see on 1st January 2018, machinery account is debited to bank of 20 lakh rupees because this is what the company has paid to the vendor to get the machinery to the business. And 31st December 2018, there is a depreciation of 2 lakh rupees. So how 2 lakh is calculated? 20 lakh rupees is the original cost of the asset and multiplied with 10%, that is the depreciation amount. So depreciation amount is 2 lakh rupees. Hence the balance carried forward to next year is 18 lakh rupees. From 20 lakh, 2 lakh depreciated, the balance is 18 lakhs. And this 18 lakhs is the opening balance for the next year, that is on 1st January 2019. Similarly, on 31st December 2019, we have to charge depreciation because it is a straight line method. We have to again calculate on the original cost 20 lakhs multiplied with 10%, so that is 2 lakhs, and the balance to be carried forward is 16 lakhs. And the same amount is carried forward to January 2020 as 16 lakhs. But here the depreciation is calculated only for 6 months because on 1st July 2020 the machinery was sold. So on 1st July 2020 the depreciation will be for 6 months, that is 20 lakhs into 10% into 6 months by 12 months. So 1 lakh is the depreciation here. The bank, we have to show it here because the machinery is sold for 10 lakh 50,000. And if you see the difference of 16 lakhs minus 1 lakh, that is the depreciation, minus the amount what you are going to collect from the customer, the difference of 4.5 lakh will be loss on sale of asset. Now let's understand the second method, that is diminishing balance method, and generally this is called as written down value method. So this method is an improvement over the straight line method. In this method, the amount of depreciation is a fixed percentage calculated on written down value or diminishing value of the asset. The amount of depreciation goes on decreasing every year, but the value of asset never becomes zero. Okay. So in this case, it is very clear that asset will be depreciated on the diminishing value. That means after 1 year of depreciation, whatever the closing balance you have, the depreciation will be on the closing balance. Correct. It has no relation to the opening balance nor acquisition cost. Okay. So let's take an example here. A machinery is purchased for rupees 10,000 and the depreciation is to be written off 10% per annum on reducing balance. Okay. So this point is very clear. It should be on reducing balance. If it is original cost, then it is straight line method. If it is reducing balance, then it is WDB method. So calculate the depreciation for first 3 years. Okay. So depreciation for first year is rupees 10,000 into 10%, that is 1,000 rupees. Correct? Because it is at the rate of 10% per year. So the closing value is 9,000 rupees at the end of the first year. Now, when depreciation for second year is calculated, we are not going to consider the original cost of acquisition like we did for the straight line method. We are going to take the closing balance of the asset at the end of first year, that is 9,000 rupees. Multiplied with 10%, then it is 900 rupees depreciation. Closing balance will be 9,000 minus 900, which ends to 8,100. Similarly, on the third year, this 8,100 becomes the opening balance for the asset value. Multiplied with 10%, then the depreciation for third year is 810 and the closing WDV will be 8,100 minus 810 is 7,290. So if you see the depreciation here, the first year is a higher amount and then slowly the depreciation amounts come down because the calculation is based on the closing balance. And if you go on like this, it will never happen that asset value will become zero. It may go point or 1 rupee like that, but it will never become zero. Okay. Now let's try to understand the merits and demerits for this method as well. So what are the merits here? This method is suitable for assets having long life such as building, plant and machinery. This method puts equal burden for use of asset on each subsequent year. The amount of depreciation goes on decreasing. For each subsequent year, the charge for repairs goes on increasing. So this was a demerit in case of SML method, that the depreciation is equal every year, and when the repair cost increases at the end of the year, the cost of asset, or you can say the absorption of the cost from the asset, is higher. Whereas in case of WDV, as the depreciation goes down towards the end of the life of the assets, and at that time if the repair is higher, then the cost burden on the company or the organization is not high. Coming to the demerit, the value of asset cannot be brought down to zero. That is there. So you can't bring it to zero as we do for straight line method, under straight line method. The determination of a suitable rate of depreciation is also difficult under this method as compared to fixed installment method. Very difficult to identify what percentage of WDV depreciation you want. In straight line method, it is very easy that you have economic life 10 years or 5 years and then you derive the percentage. But here, as it will never become zero, you don't know for how many years of you are going to use this asset. Determining the percentage is always a challenge under WDV method. Now let's try to understand WDV calculation under the same example what we have taken for the straight line method. So I am taking the same example so that we can compare with SML and find out that how it is different compared to straight line method. So the example is very clear. XYZ Limited purchased a machinery for 20 lakhs on 1st January 2018. The machinery is depreciated at the rate of 10% per annum, but the change here is that on reducing balance. Under straight line method, it was an original asset, but here we have changed to reducing balance method. On 1st July 2020, the machinery is disposed of for rupees 10,50,000 rupees. Prepare machinery account along with depreciation for 3 years. So same example, what we have considered in straight line method, but only the change here is that we'll be doing the depreciation under WDV method. So similarly, we have to create a machinery account. Okay. In the first year, we buy the asset, hence to bank account of rupees 20 lakh rupees. There is a depreciation 2 lakh rupees at the rate of 10%. So 20 lakh into 10%, you can see 2 lakh rupees here. Okay. And then here, if you see by balance carried forward, it is 18 lakhs. Okay. It becomes opening balance as 18 lakhs for the next year, that is on January 2019. And December 2019, when we calculate the depreciation, you can see here the depreciation is not on 20 lakhs here. The depreciation is on 18 lakhs. That is the opening balance what we have carried forward from the previous year. So on 18 lakhs, when you apply 10%, the depreciation is 1,80,000 rupees. Now the balance what to be carried forward is 16,20,000 rupees. That is 18 lakhs minus 1,80,000 rupees is 16,20,000 rupees. Now 16,20,000 rupees will become the opening balance for Jan 2020. And here when we charge the depreciation, as the asset is sold on 1st July 2020, the depreciation will be calculated for 6 months. Okay. And what will be the cost of the asset here? The opening balance, correct? Whatever we have carried forward from December 19 to 1st January 2020. So here depreciation will be 16,20,000 rupees multiplied to 10% into 6 months by 12 months. So that comes to 81,000. Okay. What we collect from the customer by bank, it's 10,50,000 rupees. So if you see here, the loss on sale of asset, what we derive here is 4,89,000 rupees. Clear? Whereas what we derived under the SML method was 4,50,000 rupees. So you can see by change of method of the depreciation, how the loss on sale of asset or profit on sale of asset can change. Correct? So now we will focus on the key points, what is defined under Ind AS 16, what we need to take care when we calculate depreciation. So the first one, it talks about that each part of an item of property, plant and equipment with a cost that is significant in relation to the total cost of the item shall be depreciated separately. So what it explains that if you have a bulky asset or a big asset and you feel that in that particular asset, one portion of the asset can be componentized, that means can be treated as a separate asset and not part of the complete asset because it has a different economic life, then you can segregate these two assets into two parts and depreciate differently. Correct? So if you see in the current example, there is a machine A which you have considered for 1 lakh rupees. Okay, and it has two parts, part X and part Y. Okay, part Y is a significant part of the machine and has different life compared to the complete asset. For example, the machine life is 8 years. However, part Y life is only 5 years. So if one asset you have bought, but you see one particular component is can be segregated for 5 years, then you have to segregate and then depreciate separately. So part Y cost has to be ascertained and the depreciation has to be calculated considering 5 years life. For remaining asset, depreciation will be calculated considering 8 years life. Second point, the residual value and useful life of the assets shall be reviewed at least at each financial year end. And if expectation differ from previous estimate, the changes shall be accounted for as changes in accounting estimates in accordance to Ind AS 8. So what he talks here that every year you need to see that whether the useful life what you have considered in the previous years are still continuing, or you need to change the useful life of the asset considering the business changes, considering the obsolescence because of the technology change, whether you need to continue this asset with the same useful life. If you're not going to change, it's fine, but if you're going to change, then you have to derive the impact and it has to be recorded in the books of accounts. Third, depreciation of an asset begins when it is available for use. Okay, when it is in the location and condition necessary for it to be capable of operating in the manner intended by the management. Therefore, depreciation doesn't cease when the asset becomes idle. So depreciation once the asset is available for use, okay, means it is put to use. You can say in that way. That means that it is ready for use. In that case, the depreciation starts from that day. Whether you have used for 2 hours, whether you have used for the full shift, or you have not used for 1 month, it doesn't matter. Once depreciation start, till you dispose of the asset, the depreciation will continue. Depreciation of an asset ceases at the earlier of the date that the asset is classified as held for sale in accordance to Ind AS 105. So if any particular segment or any particular asset, if you feel that you are going to transfer to a customer, you have made an agreement, but because of procedural issues, you are not able to transfer the assets, then those assets you can treat as asset held for sale. And once you treat this asset held for sale, the depreciation on that asset stops from that day. So whenever there is a, like for example, a company is going to demerge a particular division, in that case, once the agreement is finalized with the customer, those demerged business, those assets has to be categorized as asset held for sale and no depreciation will be charged on that assets. Last, if expected usage of the asset is identified, then the depreciation can be determined based on output. Okay, so there may be some particular assets where percentage of depreciation may not be applicable because these assets can generate a specific number of units or specific output. So based on the output, the company can change the depreciation every year. Okay, so let's take an example. If a tool can manufacture 10,000 units, okay, then depreciation for each year can be calculated based on the proportion of units manufactured in a particular year. Okay, so for example, if a tool has a life which can only manufacture 10,000 units, okay, then we need to say that the depreciation on this tool is based on the output for each year. Okay, so if the first year the output is only 3,000 units, then depreciation will be 30%. Correct? So 10,000 is the base, 3,000 is the unit produced, so 30% is the depreciation for the first year. And second year the output is 2,000 units, so the depreciation is 20%. So that's the end of the session. Hope you liked this session, and please share with your friends, like these videos, subscribe the channel so that you can get updated about my future presentations. Thank you.